There's a story most investors still don't understand, a story about a world where money has a price below zero, where saving costs you, lending pays you, and central banks turn the logic of finance upside down. It's the story of negative interest rates, one of the strangest experiments in modern economic history. Tonight, we're going to break it down, why they happened, what they really meant, and why the legacy of negative rates still haunts global markets today. Let's start with a simple truth. Interest rates are the price of time. They tell us what future money is worth compared to today's. Normally, saving earns interest, a reward for waiting. Borrowing costs interest, a price for taking risk. But what happens when that relationship flips? When interest rates turn negative, the message from the central bank is clear. Don't wait. Spend. Invest. Take risk. Because in a negative rate world, holding cash becomes a penalty. To understand how we got there, we have to go back to the aftermath of the 2008 financial crisis. Growth was weak, inflation was low, and fear was high. Central banks around the world, from the European Central Bank to the Bank of Japan and even Switzerland, cut rates to zero. But zero wasn't enough. So they crossed the line. The European Central Bank was first. In 2014, it introduced a negative deposit rate, meaning commercial banks had to pay to park money at the ECB. The logic was elegant but desperate. If banks won't lend because demand is weak, make it costly not to. Switzerland followed. Denmark followed. Japan followed. The new era had begun. Suddenly, investors were buying bonds that guaranteed a loss, not because they loved losing money, but because they feared losing more elsewhere. The entire concept of value began to distort. Pension funds, insurers, and savers were trapped in a world where safety had cost. Companies issued debt at yields below zero. Governments refinanced endlessly. Central banks bought trillions in bonds, trying to create inflation that never came. And yet, the experiment worked, at least for a while. Borrowing stayed cheap. Currencies stayed stable. Markets soared. But underneath, something broke, the signal that interest rates were supposed to send. Because when the cost of money is negative, prices stop meaning what they used to. A risk-free rate below zero means the very foundation of valuation, the time value of money, becomes distorted. The longer the horizon, the more absurd the math. Discounted cash flows inflate, asset prices rise, and bubbles quietly expand. By the late 2010s, over $17 trillion of global debt traded with negative yields. Germany issued bonds where investors paid to lend for 30 years. Denmark offered mortgages with zero interest. And savers in Europe watched their bank balances shrink, not from spending, but from policy. But let's be clear, negative rates weren't madness, they were a symptom. A symptom of too much debt, too little growth, and a demographic shift towards saving. When the economy refuses to grow, central banks can't raise rates without breaking something. So instead of letting the system reset, they redefined the rules. Negative rates became the new medicine for a chronic illness, one that could never be cured, only managed. It's important to understand how this world felt for ordinary people. If you were a saver in Germany or Japan, your retirement fund was punished. If you were a corporation, you could borrow almost for free, and often did, not to build, but to buy back your own shares. Inequality widened. Capital misallocation grew. Risk-taking became addiction. And yet, everyone played along. Because the alternative, deflation, defaults, depression, seemed worse. Then came 2020. The pandemic hit. Governments unleashed record fiscal spending, and central banks doubled down. QE went into overdrive. Real rates collapsed. For a brief moment, negative rates looked permanent, the new normal. But then inflation returned. Suddenly, the same policies that once looked safe became toxic. Trillions in bonds priced for negative yields imploded as inflation surged and rates reversed. Pension funds, insurers, and governments faced losses they'd never prepared for. The medicine turned to poison. And here's the part most people missed. Negative rates didn't end because they failed. They ended because inflation finally came back. The cure for stagnation created its opposite, a crisis of abundance, not scarcity. Now, as central banks raise rates at record speed, the scars of that era are everywhere. Zombie companies that survived on cheap debt are collapsing. Housing markets built on zero-cost loans are breaking. Governments are learning what debt costs again. But the most profound change is psychological. For a decade, investors believed central banks could always fix it, that money would always be cheap, that downturns would always be brief. Negative rates created that illusion. Their removal shattered it. There's a quiet irony in all of this. The world that invented negative rates to escape deflation may end up reigniting it. As debts rise, growth slows, and populations age, the gravitational pull toward lower rates remains. When the next downturn hits, the temptation will return. Will central banks go negative again? Probably not openly. The backlash was too fierce. But they'll find new tools: yield caps, targeted lending, digital money with embedded rates, different names, same logic. Punish saving, reward spending. Because in a world addicted to debt, negative interest isn't an anomaly. It's the natural consequence. It's what happens when we can't afford the real price of time anymore. So what's the lesson? That money without a cost stops being a signal and becomes a sedative. It numbs risk. It dulls discipline. It buys time but not solutions. Negative rates were supposed to make us move faster. Instead, they froze an entire generation of capital. And when the tide turned, the pain of leaving zero proved worse than the comfort of staying there. This was the hidden truth of the last decade. We weren't living in a boom or a bust. We were living in suspended animation, where the heartbeat of money was artificially flatlined by design. And now, as we return to positive rates, we're learning what real gravity feels like again. If this helped you see the deeper logic behind the strangest monetary experiment of our time, make sure to like, comment, share, and subscribe, because we're about to explore the next chapter. What happens when the world tries to live without zero?